Good afternoon, everybody. Welcome to the DBRS Morningstar webinar on U.S. reverse mortgage market, given in Q2 2023 by two presenters, myself, Derek Moran, and my esteemed colleague, Joe Morgenstern, who both of us have long roots in reverse mortgages. Joe, do you want to give a few second bio and then flip back to me?
Sure, absolutely. Thanks, Derek. My name is Joe Morgenstern. I am a Vice President of U.S. RMBS Surveillance here at DBRS Morningstar. I've spent the majority of my career dedicated to the reverse mortgage industry with a specialization and focus mainly on analytics and marketing.
Thanks, Joe. And I'm Derek Moran. I'm a Senior Vice President in the analytical group of reverse mortgages here at DBRS Morningstar. I've been familiar with reverses in general since about 2010 when I used to work on a buy-side desk, trading about $500 million worth of HECMs and got interested in the product. In 2017, joined the ratings agency to build out models and such to allow the rating of this product set, and has been enjoyed being in that seat ever since. So let's launch right into it. The presentation agenda is going to cover a basic industry overview. We're assuming many people on the call know reverses fairly well, but maybe one or two don't. We'll do the ever so brief intro to the sector. And then we're going to drill down a little bit more into the subsectors, contrast the proprietary collateral versus the HUD-insured HECM loans, and active versus non-performing. We're going to show some geographic distributions, what's going on across the country, plus some spread levels for the HECM CMOs. Then Joe's going to take us through some drivers of loan performance, which is taken from our own portfolios, which have comprehensive loan level data, and we are going to see the underlying drivers and workout modes at the loan level. And then finally, I'll lead us through some deal performance metrics of the actual rated deals, how the ratings are holding up, and how our predictions are comparing and contrasting with what really is coming in the door. And I, in particular, was interested to track the effect of the COVID-19 event, and you can see that in some of the data. And finally, we'll end with Q&A. There's a little question mark in your session. You should be able to enter questions, and we'll address those at the end. Launching right into it, this is the overview of the market from the vantage point of the ratings agency. Again, I'll give a quick intro to reverse mortgages for people who may not know them. They're typically first liens to seniors. They differ from traditional mortgage product insofar as they have no periodic cash payments and balances accrue as opposed to amortizing down. And the cash is typically covered in a single event at the end, which means that these products are a little bit more influenced by and exposed to ultimate home value at the time of the event. And we're going to show you how the ratings agency simulates those home values, which has a fairly large influence on the ratings. We've to date rated 71 transactions through 2017. Collateral broadly spans into two groups: private label, aka proprietary or prop, which contains no HUD insurance, and these are mostly active, recent issue, larger loans. And the HECM buyouts, which are HUD-insured loans, typically originated, 10 to 15 years ago, and were originally securitized in Ginnie deals and are spun out of the Ginnie deals either by being non-performing loans, so they have to be bought out, or they are still active and they've reached their buyout maximum claim amount, which is when they have to be bought out. Top right of the chart, the DBRS Morningstar rated universe. I mentioned 71 transactions so far, spanning over 20 billion in current UPB. At the time of original rating, 43 of these deals were public and 28 were private transactions when issued, although I'll just note that earlier this week, we translated 23 of those privates into public, so those are now public ratings. So now suddenly the universe from our seat is a lot more public than it used to be. 10 of these deals have been successfully called with 61 outstanding. The collateral types, like I mentioned, predominantly set number one, the active private label, or the prop, 47 deals are there. Flipping to the bottom, number four, inactive HECMs, the HECM buyouts of non-performers, 17, and the rest comprise a mix of active and inactive HECMs. And some At the bottom, I list some public deal examples. You can go to our website and pull those up and pull up the original deal documents if you're interested. This is the timeline of our span in the reverse mortgage universe. In 2017, according to this timeline, we rated our first transaction, and 2018, we rated the first public transaction. So the first transaction ever was a private one, so not many people got to witness that. 2019, Morningstar Incorporated acquired DBRS, and we became DBRS Morningstar. 2019, we rated our first tech and buyout transaction. 2020, our first transaction ever rated as successfully paid in full, which is a good result. Everyone likes to get paid in full. 2022, we rated our 50th mortgage transaction, and still waiting for a big party on that one. And as of April this year, we are up to 73 and counting, because we still have a few live transactions in the hopper. Some highlights from last year, quite eventful. January, RMF acquired AAG servicing portfolio of $12 billion in total UPB, which came back to bite them in November. In March, the HECM volume hit the high of origination of the decade, and C-Link won, which is the largest servicer in the industry, won the government servicing contract, which is a notable thing. November, shocking news, RMF filed for Chapter 11 bankruptcy. Their buyout portfolio, amongst other things, had been demanding $100 to $150 million in buyouts every month, which is too much of a load to bear in this environment, given that they couldn't securitize. This was all upside down, and we can talk a bit more about that a little bit later. But the actual rated transactions are fine. The bankruptcy was unrelated to those things. In December, GMA took over the RMS service portfolio, and unrelated to that, the HECM lending limit was increased to just over $1 million. And now, handing over to my data guru, Joe is going to lead us through a few of these slides he's put together. Joe?
All right. Thank you, Derek, for that overview. So let me start off with some retail metrics. Understanding these trends and figures will help build the foundation for understanding some of the principles we're going to discuss later in this presentation. This data is based on the Loan Application Register, which is provided by CFPB. If you're not familiar, lenders are required to send in effectively a list of their applications with varying attributes to CFPB annually, and this is public data. I also want to note that it includes all reverse mortgage applications, and so it is representative of the bulk market. With that being said, I'd like everyone to focus on the chart on the right. Pictured here is the historic trend of applications and originations from 2018 through 2022. Up until 2022, applications and originations shared a fairly proportional increase, as you can see by the blue and red line. Excuse me. This ultimately led to a fairly stable origination rate trajectory, which is the yellow series above it. However, in 2022, we did see applications continue to rise, but the originations remained fairly stagnant. And what this does is it effectively starts to lower your origination or your conversion rate, which you can once again see demonstrated by that yellow series there in the chart. This data could suggest that the application qualification is coming down while marketing efforts are still high. So that's one possible indication that this could be telling us. All right, so jumping into some distributions here. In regards to the retail marketing efforts, I like to look at the overall market penetration. And to do this, we've compared the application data with the total senior population for the respective state. And we can produce the chart on the left. So from this image, we can quickly tell that marketing efforts have been centered around mostly the West Coast, likely due to higher home values and higher balances, as we'd expect to see. Interestingly enough, Utah has by far the highest market penetration, with nearly 0.75% of all seniors having applied for a reverse mortgage in 2022. So that's effectively how you would interpret this is what portion of the senior population there applied for a reverse mortgage, in this case in 2022. And so it's a very good indicator of how much of that market is being captured in that particular state, of course. And the chart on the right breaks down the conversion rates by state. So similar to the conversion rates from the previous slide, except now it's broken down by state. Once again, the West Coast is highlighted as these states typically grow a greater level of, show a greater level of conversion, with Utah in this case also leading at 67.5% there. So 67.5% of reverse mortgage applications from Utah turn into actual loans or are fully originated is what that means. So continuing with some of the bulk market retail metrics here, we are now looking at the overall breakdown of HECM applications specifically. We all know that we've gone through a refi boom recently, and so it's important to kind of show how that's affected the reverse industry specifically. Looking at the chart on the right, it's not a surprise to anybody in the audience that these refinances did significantly increase in volume over the COVID era. Rising home value appreciation and sinking rates create a pretty favorable refinance environment. It's, specifically, HECM refinances, or HECM to HECMs as they're sometimes referred to as, these increased through Q3 of 2021 until plateauing, as you can see there, at about 50% volume. So 50% production of all HECMs were refinances in that period is how to interpret that. In May of 2022, refinance trends obviously shifted. As we could see, they began falling back to approximately 10% of production where we're seeing it today. I'd also like everyone to kind of make a mental note and to keep in the back of their minds that May 2022 period or date, because it's going to come up a few times throughout the rest of the presentation. All right. And just to briefly go over this once again, we've kind of been reiterating a lot of this at this point. If we break down the top states origination for both props and HECMs, and these are the bulk markets for each one individually. If we break those down, we know that California makes up the bulk of the prop markets. However, I do want to point out that specifically we can see California dropping fairly substantially. In Q1, it started out, or Q1, I'm sorry, 2021, it started out nearly 90% of all prop volume. And by Q4 of 2022, in some of the more recent data, it's dropped down to nearly 73% of overall prop production. And so we do see a similar trend on the HECM originations. However, it's a little, it's albeit less dramatic, of course. One reason proprietary products have such a large portion of market share in California and some of the other similar Western states is due to the higher home values and higher property values in general, many of which would be above the HECM lending limit. And so a proprietary product may have been more advantageous for that borrower. And so that's part of the reason as to why we see this distribution. All right, so let's now break this down into the subsectors. We're moving away from the bulk markets and focusing now on the DBRS Morningstar's rated universe specifically, so keep that in mind. As Derek mentioned in the introduction, we tend to split our rated universe into three distinct subsectors: active buyouts, non-active buyouts, and the proprietary products. The chart on the right shows the distribution of active buyout collateral, or ABOs for short. As many likely expected, California, Florida, Texas, and New York make up the top 4 states, holding nearly 40% of all the ABO volume. We've also gone ahead and included the average haircut valuation, which is simply the property value with a 5 to 10% haircut, depending on the latest appraisal date. And this is something that we do to further, stress the scenarios when we are modeling these. With ABOs, it's typical to see average UPBs at or even higher than the haircut value. And this is usually due to the fact that the collateral is at least 98% of the max claim value when it's coming into these pools. So it's not unheard of to see the average UPBs higher than the average haircut value, which you can see in that table below. Moving on to the non-performing or the inactive HECMs, or NABOs for short. Similar to the ABOs, we see a distribution that highlights Florida, New York, and California again. However, Puerto Rico has made its way into the top 4 states, mostly due to the foreclosure moratoriums that delay the liquidation of the collateral quite a bit. And some of that has to do with both COVID as well as some natural disasters that Puerto Rico has faced in the last few years. And so that's gonna delay the foreclosure timelines fairly substantially. And we'll talk a little bit about that later when we understand the pipeline or process for the non-active collateral. But I just want to point out that Puerto Rico is on here, but it's not necessarily representative of the overall market, other than the fact that they've been delayed quite a bit due to some legislative reasons. And like the ABOs, on the NABOs or the inactive collateral, it's not uncommon to see the average UPBs higher than the average haircut value, of course. And finally, we're moving on to the proprietaries. So with the proprietaries, or jumbo reverses, as they're sometimes called, California makes up nearly 60% of the overall volume alone, with the top 4 states comprising about 75% of the overall market. Despite the shift in distribution, California, Florida, New York, and Texas all remain in the top states for props. Unlike ABOs and ABOs, though, we generally do not see average UPBs higher than the haircut values for props. Props typically start at lower LTVs compared to HECMs, so this helps to reduce the LTVs throughout the life of the loan, of course. Besides marketing efforts focused on high home values and balances, props have a unique distribution, also due to licensing and legislation. I just want to point out, for those not familiar, not all proprietary products are approved in all states, unlike HECMs. And so there naturally will be a different distribution, across the states, simply because some states don't allow proprietary products at all, for example. Or some states may only allow a floating product versus a fixed product. So it does change the distribution a little bit due to that. So as I mentioned on some of the previous slides, marketing efforts focused on high home values and larger balances will always shift the volume distributions to higher valued areas like the West Coast. Since reverse mortgages in general have such low LTVs compared to other products, it's crucial for the qualifying property to show a significant level of appreciation to be able to actually fit within that LTV restriction. This is even more important when it comes to HECM refinances, as the appreciation has to overcome the accrual on the balance from the time that loan started to the time it's being refinanced. Looking at the distribution of HPI increases over the past couple of years helps to shed some light on some of the previous points we've made earlier in this presentation. For example, we can see that the HPI has come up quite a bit throughout the entire country. However, isolating the last 6 months of this period reveals shifted vectors. The East Coast remains in a positive light, which you can see on the chart on the right. But Western states are starting to see their HPIs retracting quite a bit. So that last 6 months of that same time frame we see on the left, that same time frame, that those 6 months, which we now see on the right, are showing kind of a varying, slightly different trajectory than you see overall. And overall, this can lead to lower qualification rates in those particular states. So we may see a shift in origination distribution due to this. All right, and I'm going to kick it over to Derek, and he's going to talk about some of the spreads and valuation vectors. So go ahead, Derek.
Thanks, Joe. So we're going to shift around a little bit between the sort of the geo overviews. I'm going to throw in a few peripheral slides, and then Joe's going to go into some loan level details. From a ratings perspective, we are comparatively isolated and agnostic to trading spreads, but many people operating in the industry obviously interested in where they can buy and sell these products. The floater CMO offerings have been dominating the market for the last decade or so, and they've been trading in bands between about 60 to 100 DM over LIBOR or SOFR, depending which you're looking at. I do note that the last time we gave a presentation was right at the start of the COVID event, which you can see as the spike sort of around about early 2020 here. So that the spreads gapped out quite a bit, but then they came ramping back in fairly quickly after that, and since then they've tightened up a lot. And then, as you can see, roughly starting in the 21, spreads in general and rates have gone out, blown out a lot, and the floaters have followed along. So I think we're in a kind of a different trading regime than we were in the last many years of low rate environment. So that has been, at least I think we're we're in a different environment right now. Moving on, we had mentioned the impact of the home prices on the product. This determines what's left at the end of the day if you have to liquidate the home. So we're fairly exposed to home prices. Our modeling is fairly tough on these forward home prices. So what we do is if we see a pool of loans, we will evaluate them up to today's value, and then we'll haircut them, like Joe mentioned, under 5 or 10% typically. If it's a very recent full appraisal, it might just get 5%, everyone else gets a 10% appraisal. So you can see the little drop off in the value we were given of the yellow line. And in the B scenario, we just assume home prices remain flat forever, which is a fairly tough assumption in itself. Most people are, assuming that home prices are going to grow at about 4% per annum over a long period of time with some ups and downs, but flat is pretty tough. Single A roughly looks back in history and is at a zip level about as steep as and as harsh as what happened to those zips in the credit crisis event, which is the worst event in our time series dating back to 76. Some of the tables on the left, you can see example states for declines. Florida at the top of the chart here has an average decline of 70% in AAA. AAA is 30% worse than our single A event, and a maximum decline, depending which zip you are, of 78%. So certain zips are experiencing almost a haircut from that value of 80% loss in the AAAs. That's pretty tough. But some of the most impacted by that are like places like Las Vegas that historically had, and Fort Lauderdale had enjoyed very big price run-ups running into the credit crisis, and then reverted quite badly after that. So that that's just, it is what it is. The more protected against these are places like Washington D.C. that are more reflective of the national average. Anyway, a lot of what goes on for our modeling is fairly strongly influenced by these pretty tough home price declines. Flipping around and setting stage for some of the data that Joe's going to show, obviously we have a fairly large book of loans that we're monitoring. With due modesty, we are probably the best seats in certainly the ratings industry to observe these things. We've rated most of the deals since 2017, so we have access to pretty much everything that's gone on in the private label markets. As opposed to the Heckens, and so we have a rich data set that I don't think many other people have access to. So we're going to look at this for two ways. One of which is to sort of inform us as to what's really going on in the market, and then we also want to check that our assumptions in our modeling kind of comports with what we're seeing in reality going on there. On the left-hand side there's a rough flow chart of how our model looks at inactive, the non-performing loans, which enter our universe either in default or some state called due, or some case of foreclosure, and they walk down the pipeline typically, and they might have a HUD claim, and then ultimately they end up in the paid state. They can also get pulled out of this pipeline and be, cured or just pay it out. There are other modes that they can get to a resolution state. For the active loans, they could obviously become inactive, so they could enter one of these states, but they also can end their lives by, the borrower experiencing mortality event, which means that the loan. Hello? So can I be heard? My line just dropped, unfortunately. Okay, I'm back. Geez, that was an interesting event. Well, I hope that doesn't happen again. Okay, so I'll move it on and hand over to Joe, who might have a more stable connection. So we're examining the mortality, the prepayments, the assignments, and the default modes, effectively. And so we have a lot of data that went into these things. We like to examine, make sure that we're still on the money with these things. So this here next chart that Joe will lead you through is a sort of a timeline of a single loan, which is interesting to walk through.
Yep. Thanks, Derek.
Go ahead, Joe. Thanks. Thanks to everyone who says they can hear me now. My phone is blowing up.
Thanks, Derek. Per what you just described on the previous slide with that breakdown of the non-active timeline, that's something that, of course, as you mentioned, we incorporate into our analytical tools. And so to demonstrate this, I've actually pulled a real-world sample loan that followed, this pipeline. This is a pretty typical example. This particular loan came into the pool already in pre-foreclosure due to the last remaining borrower passing, and so it came into the pool around January 2020 at issuance. From that point on, it took approximately 10 months before the home was placed for sale and then sold another 4 to 5 months later. And so you can actually see that transition there in that first leg of the chart on the left, where it says liquidated held for sale is when it was actually posted for sale. And then at the 100% mark, that is when the loan was actually liquidated, or the collateral was liquidated. And up until that point, the balance continued to accrue an additional 12% before that liquidation event. So once again, that's pretty typical of what we see here in terms of overall amplitude and timing. With that being said, as the chart demonstrates, the sale of the property was not substantial enough to cover the total balance in this particular case. And so due to this, the issuer had filed a claim with HUD, specifically a Type 21, which is for foreclosures or short sales. And then the proceeds of that claim, it appears, was received approximately 6 months later, where the loan was then declared inactive because it was paid off. So once again, this is a fairly typical progression for a non-active HECM that we do see. And in this case, in the case of a curable default, such as an occupancy default, those loans would typically exit much earlier in the pipeline, sometimes prior to even being referred to for foreclosure. Usually when the borrower becomes aware that they're in default for a curable reason, they generally work it out with the servicer. So they would have left the pipeline much, much earlier in this process. But this is typically what we see as far as inactive loans go. So with these subsector interest rates, we've gone over kind of a lot of the fundamentals, but I'd like to shift gears a bit and focus on some of the subsector and loan level performance. And we're starting off with the interest rates in this case. So these are plotted. These are the average interest rates plotted against time, and these are specifically average interest rates at new issue. So these aren't the initial rates at which the loan was originated with, but when they were actually issued with the transaction. So with that said, props in yellow have shown a massive increase in rates, as you can see, from less than 6% on average to nearly 10% in about 18 months, which is pretty dramatic in my opinion. And non-active HECMs or the NABOs also show a similar trend in the sense that the rates climbed substantially in the same period, topping over 6% with our current data. However, the ABOs typically follow a far smoother trajectory, so they're not being as affected as much by the bulk market that we've described earlier. And this may partially be due to the fact that the average vintage of the ABO collateral is quite a bit older than some of the other subsectors. So just keep that in mind when you're looking at the data as well. Okay, so how are rates, HPIs, the overall market distribution, affecting performance? I'm sure a lot of people have that question as they're going through this presentation. One of the first metrics that we look at when we're discussing this are the CPRs, the conditional prepayment rates. And this data was provided by New View Advisors, and it covers the bulk proprietary and HECM markets, but it does not break it down into subsectors. So I want to clarify that. For those in the industry and retail, the dropping of CPRs from July 2020 through February 2021 may have come as a shock, as many of your marketing efforts probably became less efficient. And you could see that where the CPRs are dropping quite a bit, there was far less origination activity in those times. For a short while, borrowers were reluctant to refinance or move from their homes, et cetera. but this quickly shifted as rates started dropping, of course, and CPR started rising. CPRs in both markets continued to rise, as you can see by that hump towards the end of both of those charts. And they kept rising until they hit about 23% in May of 2022. So that's about the same across both markets here. From here, CPRs have dropped off and may actually be heading back down towards the minimum levels again. I also want to emphasize too that how high these CPRs have actually gotten. This chart only goes back to 2017. However, long-term CPRs on props, for example, if you go all the way back to you go back several more years, long-term CPRs on those props have been notoriously in the 15% range. And so we can see the past couple of years have been substantially higher than that for the most part. So as I mentioned in the previous slide, it focused mostly on the bulk prop and bulk HECM markets, but I did want to break this down a little bit further to show something interesting. So when you isolate the cash flows from the NABOs and you can kind of demonstrate what I call a quasi CPR. It's not exactly the same, but it's the overall all-in payment rate, so to speak. And to clarify, that's what I'm referring to is this includes all principal being allocated towards the collateral balance. With that being said, unlike the bulk markets, the NABO collateral specifically has not shown the same trend in CPRs. Over time, NABO CPRs, as you can see, have continued to increase and have not been subjected to the same shifts and trajectories as we saw on the previous slide. And one potential explanation for this in particular is that the NABO market follows its own pipeline, as Derek kind of described through that workflow. They follow their own pipeline, and they may just not be as vulnerable to the shifts in the bulk market simply due to that fact. So up next, we're looking at the credit growth performance by subsector. We've also broken up the proprietary subsector into its own subsectors, if you want to call it that, such as new performing, seasoned performing, and new performing high line of credit, which you can see in the table in the top left. You can see that the typical performance that we'd expect to see with AAA rated classes generally showing higher credit build than the lower rated classes. I also want to note that ABOs and props sometimes have revolving periods in their structure, which can further delay credit growth as well. The transition matrix in the bottom left demonstrates the historical rating actions from original to current. Overall, 315 classes were originally rated, with 33 currently being paid in full, 48 being upgraded with an average upgrade of nearly 3 notches. And of course, we've seen 0 downgrades in this space. So that is always exciting to see, and some great news there. The plot on the right shows the credit growth versus deal age. In a favorable environment, we hope and expect to see a trajectory of credit growth move up and to the right as time progresses. Fortunately, in this case, we actually are seeing that. And it's reaffirming that our ratings are appropriate for the performance levels that we are seeing. But overall, if you look at the top chart to the left, you can see the progression from the AAA rated groupings down to the triple B high to B flat rated groupings. And typically speaking, we see a similar trend of higher growth at the higher rated groupings. So breaking this down a little bit further, we could separate these plots into NABOs and props, so into some of these subsectors. As we saw in the previous slide, the trajectories look consistent with what we would expect when comparing across the rating categories. I'm sorry. One thing to note here is the initial delay in credit growth on the proprietaries. This is typical, as many proprietary transactions have a revolving period incorporated in their structure, as we've alluded to on some of the earlier slides. The revolving period effectively reinvests principal back into the collateral, into new collateral, and that's going to, of course, slow any credit build, at least initially. And these periods may last anywhere from 6 to 24 months. So I just wanted to point that out and kind of show that even breaking these down into the subsectors, we're still seeing fairly similar trends amongst the rating groupings and credit growth. So it's awesome to see that. And besides credit growth performance, we also look at the losses and average severity of those losses over time, of course. This not only checks the performance of the transaction, but also once again helps us to calibrate our analytical tools and kind of compare what we've been doing to actual performance. The first chart on the left shows modeled loss severities for a recent NABO or inactive HECM transaction. As pictured by the pink bar, actual losses for the deal fall in line with that of a B-rated scenario for the most part. And you can see the overall distribution for the various rating scenarios there. The chart on the right shows modeled loss severities for a recent prop transaction, a proprietary transaction. And this particular transaction, there have been 0 reported losses, so the actual loss severity remains at 0, demonstrated by the pink bar. And little to no losses are typical on proprietary collateral, as we see underwriting guidelines are more stringent and LTVs or the PLFs are typically lower at origination, which helps to mitigate losses there.
Joe, on the left there, I just wanted to make a point that some of those outcomes can be gains as well. So the bottom left, not everything results in a loss due to some of the mechanics of the claims. If you have a HUD claim on the interest rate that's based by the debenture rate, which was set years ago in a fixed rate environment, and you have a floating rate loan, you can actually be growing your loan slower than the HUD claim is growing, and some of the mechanics of the workout can actually result in you posting a negative loss, which we're going to see a little bit later in the data. Thanks, Joe.
All right, thanks for that color, Derek. So where does our current universe stand as far as the loan level performance goes? We can go ahead and we can take a look at it by grouping. We can look at it by breaking down the loan level status for each of the subsectors to provide some more color on the makeup of those deals. And so for props, which originally started as active, of course, mostly still remain active at about 80% with that blue bar you see there. However, ABOs, which originally started as active as well, only have approximately 35% active remaining. And that's also that blue bar you see in the middle of the chart there. Moving on to the NABOs, which started as inactive, of course, now have approximately 10% active, which is interesting because what that means is it means the portion of collateral was cured back to active status. So 10% of which, 10% of the inactive collateral in some way, shape, or form was cured back to an active status. And the rest remain inactive or have been paid off, of course. So that's the overall distribution of where the current universe stands as far as current statuses. So on ABOs and NABO collateral specifically, issuers tend to group their collateral or designate it into various intended servicing strategies, such as assignables, strategic holds, and liquidations. Since ABOs start as active HECMs, it makes sense that issuers would intend to assign the majority of these loans, of course, because that is the whole purpose of them being bought out in the first place. Most of the remaining would be strategically held for investment purposes. On NABOs, which start as inactive HECMs, these likely face a future of liquidations through short sales and foreclosures. However, approximately 14% of those are designated to be assigned to HUD. And what that tells me is that the servicers or the issuer is anticipating actually curing about 14% of the loans. So they expect a good portion of the inactive loans to actually become active again. And what's interesting is now we can compare the real exit modes or the real cash flow events to what the servicer had intended originally. For ABOs, the bulk are assigned as we expected, but liquidations and the paid in full collateral appears to be a little skewed likely due to servicer description errors. Not all servicers are equal in the way that they describe the statuses of the loans and how they exited. So just keep that in mind as well. NABO saw nearly a 68% of their collateral get liquidated, which is just under that 70% mark that the servicers or issuers actually intended. So servicers and issuers are really hitting the mark as far as NABOs go with what they intended to actually do with that collateral. And then the props saw nearly all of their collateral paid in full, so close to 100% in this case, and less than 1% were liquidated. And that's pretty much what we would expect to see there. For the proprietary products, we wouldn't expect to see any of them assigned, of course, because they're not HECMs. Moving on a bit here. Out of the inactive loans we've discussed up to this point, which actually but what actually has caused them to become inactive in the first place is a question I'm sure many of you have. The chart on the left demonstrates the typical breakdown of trigger events by each subsector. ABOs being mostly actives will not have a large amount of inactives throughout the life of the transaction, of course, but those that do become inactive are mostly refinanced with little going into default. NABOs, which are nearly all inactive, have a more widespread distribution of trigger events, as you can see here. Nearly half of the inactive HECMs were triggered by a tax or insurance default and or bankruptcy. As expected for the props, the majority are refinances with a large portion of inactive collateral triggered by mortality events. So not a whole lot going into a form of default. Overall, occupancy defaults are low and likely curable in many of the instances. If a borrower just fails to sign their occupancy certification, which does typically happen, usually the servicer will work with the borrower to get that remedied, and their loan can be returned back to active status. Repair defaults are trivial and typically will not become prevalent in these transactions, as HECM borrowers generally have 6 months from closing to complete repairs on their loans, and the average vintage of the HECMs in our universe are far older than that, and so any sort of repair defaults would likely have been worked out prior to entering our universe. So that's the reason for seeing so few on the HECM side. Right. And out of the property charge defaults and bankruptcies we discussed on the previous page, you can actually break that down even further as well, and we can get a distribution of what's actually causing many of these defaults in the first place. So for the ABOs that actually did go into default, nearly 99% of which were tax or insurance default related, and only about 1% was related to bankruptcy. For NABOs, they have quite a bit of tax insurance defaults, as many would expect, but also a substantial amount of bankruptcies, nearly 20% in this particular case, which we don't see a lot of in some of the other sectors. With props, they're split more similar to ABOs with fairly de minimis bankruptcies, and this may be due to the fact that props have much stricter underwriting guidelines, and their borrowers typically have more favorable credit profiles that may prevent things such as bankruptcies. And as a note, nondescript servicer statuses that do not differentiate between tax or insurance default, for example, have been excluded from this analysis just to avoid skewing that even further. And as promised on some of the previous slides, we also took a look at what proportion of collateral took losses, but also at what loss severity. Overall, proprietary collateral typically has about 1% posted losses, or about 1% of their collateral post losses, I should say. However, despite losses being low, severities are the highest of all the subsectors, and this is likely due to the lack of HUD insurance and higher proportional changes on larger home values for that market. So we do see higher losses with props in terms of severity, but the actual proportion of collateral that we see have losses is very low. The ABO collateral shows nearly 80% of the collateral post losses, with an average loss severity of about 8%. And as mentioned before, it's not unusual for ABOs to have UPBs higher than that at the home value, and this may help explain the higher proportional losses there. And despite the collateral being inactive, NABOs show about 30% of their loans post losses with severity lower than that of the ABOs or props. And NABOs can take advantage of the HUD insurance, and so of course it's going to help mitigate losses further. Right, and now I'm going to kick it back to Derek, where he will go over some beautiful case studies that we've put together, and I think everyone's going to really enjoy this part. So take it away, Derek.
Yeah, thanks, Joe. So I certainly I love these next 3 slides. You guys have hung in through some nitty-gritty data. These slides at the end here, we're in the final stretch, and I think these are the most interesting. Well, certainly to me, not to undermine everything else. The stuff that Joe presented is also critical data, because we want to ensure that the assumptions we put into our modeling are comporting with what's really going on, and or the production of our basic modeling is accurate in terms of severities and things like that we are seeing is dealing with what's in the real world. So, that's from a fundamental perspective. We also want to obviously look where the rubber hits the road in terms of the deals, right? So I'm going to show you 2 case studies. one being a NABO deal and the other one being a prop deal. This one here in the middle of the screen, you can see CFNT 2020 HP4, which is a waterfall HECM buyout deal comprising purely non-active, non-performing things. The first bullet at the top says, in the first few periods since closing late 2020, cash flows are arriving quicker than our model, even though in the base scenario. I'll note that when we went into the COVID-19 crisis, there was a lot of head scratching about what was going to go on and how long it was going to last and what the effects are going to be. And in general, we added extra stresses to our stress suite to reflect our anticipations of what was going to go on with COVID. We had three basic effects. One was which mortality was supposed to increase. So that is undeniable. We expected seniors to be unfortunately dying more due to COVID, and that makes a lot of sense to everyone. The second thing we anticipated was that foreclosures were going to take longer, and that's due to the fact that appraisals and everything else were just going to be much more lengthy to try and get through, and auctions would be poorly attended and things. There's good reasons to think that. And the third effect was we thought that home prices might take a ding as well. Home prices, in fact, did just fine. But the other two effects were valid. In particular, we lagged all our workout delay timelines on any liquidations to the AAA timeline in the adverse scenarios. We came up with two scenarios. We originally had all our base scenarios, and then we had some adverse COVID scenarios. And due to the outlook of our global macro team, they thought we were going to have somewhere between our adverse scenarios and our base scenarios. So we had halfway down was the moderate scenarios, which is what we're actually applying. So if adverse delayed everybody to AAA, is what you're showing here, we actually rated to the moderate. So enough of that leading into it. At the bottom left, this is the Class A credit support on this deal. The green solid line is in the single B scenario, how we anticipated the credit support is going to grow on this particular tranche. So it started at about 20%, and if things just went just fine without any stress, it was going to grow and hit 100% credit support, which is in effect, is going to be paid off. Each of these lifespans of a credit support profile is going to either end up at 100% or 0. 0 is the bad outcome. It means you took a loss. 100% means you got paid off ultimately. The yellow is the single A and the blue is the AAA. AAA happens much slower and struggles to get there, but ultimately does in our rated scenario. If it didn't get there ultimately, it wouldn't pass the scenario, so it has to get there ultimately, otherwise it wouldn't be rated AAA. And you'll notice the dotted lines are the lags we implemented. So the green dotted line is the B after we've applied these COVID lags. The yellow dotted lines, the single A after we've applied the COVID lags. And the blue dotted line coincides with the solid blue line because the lags are the same as they started at the same time. So how did that really come to fruition? And this is very interesting to me as someone who were going into this, nobody knew it was going to happen. So this is like your report card. And we did pretty well, I have to say. I mean, if you look at the red line, two things I take away is that our moderate COVID, which is the actual rated stresses we're applying, comport very closely with what was actually coming in the door. So the red is, and I think that is remarkably close, for one thing. The second thing is this tranche has grown from 20% to 55%. So notwithstanding our projections, it's growing just nicely, and I think the performance is very good. So it's all a good story. So I took another involuntary break, so I'm back again. Hopefully that won't happen any more times. The same scenario just viewed from the cumulative cash flows. You'll notice that the green, gets cash in quicker and accrues more. The more stressful scenarios get their cash slower and get there ultimately, they get less cash out the other end of the spigot. And the AAA is obviously the harshest. So how did this actually happen too? Well, it turns out that the actual cash flows roughly came in, with the lag profiles too. So that's not a bad outcome either. So moving on, same deal, and I'll try and wrap this up fairly quickly, lest to get kicked out again. Same deal viewed from the slide of cumulative losses to the deal. Clearly, we are pretty harsh in terms of our assumed losses. So this is how the deal on the left-hand side really came through. The red line is the actual cumulative losses versus the expected cumulative loss in these various scenarios. On the right-hand side is a magnification of this because obviously it's pretty small. And so a couple of takeaways. Firstly, that the red line on the right-hand side is quite well below the stress lines, which is kind of where we had hoped it to be. Not too far below. Right now there's 73 basis points of losses built over three and a bit years since this deal's been running, which is fairly modest in a non-performing loan deal. I'll also notice that it's inside of the single B, which is good. Notice how the single B dips down again, right? So these are cumulative losses. Remember, I interjected with Joe earlier to say, to point out that some of these things can actually take gains. So if you're having negative cumulative losses, some of these loans are posting gains in our modeling. But if you look at the red line, and it's a little bit non-distinct here, but some of these red lines actually, the cumulative losses do go down a bit as well. So look at August 22, it sort of goes down before it starts building up again. So message is that the modeling is doing a good job of being conservative, and the deals are performing very well. I'm going to flip over to the case study, the prop deal. This is one of our reverse mortgage funding deals. This is the first deal we ever rated, which is the RPIT, otherwise known as RIPIT, 2019 number 1. I stress that this entity filed Chapter 11 bankruptcy in November 22, but the deals themselves are continuing with some degree of changes due to servicing and processes and extra fees and things like that, which we've all analyzed and talked about quite a lot. But just net, this deal is doing just fine like everything else. So I want to go and look at the credit support growth on the left-hand side for this prop deal. The green line, which is the actual, is growing quicker than even our B scenario, so that's good. And so it's fairly good. And this is a AAA rated note, so it is the credit support growth in actuality is well outpacing the blue line, which is what is expected to do to pass AAA. So that's it's not going to get upgraded, but it clearly is erring on the correct side. If it was underperforming these metrics, it might be looking for a downgrade. Flipping to the right-hand side, again, the cumulative cash flow. Once again, the blue line, which is AAA, builds cash slower and ultimately gets less cash in the door. This is an interesting thing because the green line is growing very fast. And recall how Joe was highlighting the very high and unusually high prepayment rates we've been through in the period up to the May 22 date, which is what I asked Joe to stress a few times, because when those prepayment rates drop down to normal, partly due to the interest rate environment, we suddenly made refinancing a lot less attractive. But you can actually see it in our data here. So the green line came out the gates much quicker than even we had anticipated. But now it's basically reverting to trend, which is probably good. These proprietary deals are under collateralized, so usually getting more money in quicker is helpful. But in these deals, if you get money in too quickly, there's not enough money to pay the deal off, so you don't want to be paying too quickly. So we also, in addition to our stress scenarios, we apply high CPR stress scenarios. We want to make sure that these things pass even in these scenarios. So this actually followed our high CPR stress scenario for the first half of its life, and now it's probably reverting to more like a traditional profile. But net, again, this deal's doing just fine, and it is perfectly capable of passing AAA, even factoring in the extra servicing charges for RMF. So I'm rushing myself a little bit now due to my technical malfunctions, but we've reached the end of the presentation, so thank you for hanging in there. And we have reached Q&A time. I just want to give a quick recap that we highlighted these various different subsectors: prop versus HUD, active versus non-performing. Joe showed you some interesting geographic data, geographic dispersions. recall how our zip level home price vectors are strongly influencing the ratings, and they're pretty tough. Recall the spreads. And also Joe led us through some pretty detailed loan level performance data that I think is pretty hard to acquire anywhere else. So that's, I think that's a value add for anyone who's stayed in touch with us here on this presentation. And finally, I think the deal level performance metrics, even though I rushed it a bit, are interesting and supportive of the fact that the collateral is doing well and our rating scenarios are doing a pretty good job of comporting with reality too. And I also noticed that COVID-19 crisis and other things are visible in some of the data. So I'm going to look for some questions that you guys had.
Yeah, I think we have time for a couple.
Yeah. Joe, you must have gathered a couple. Do you want to just fire off one or two and then?
Looks like, it looks like we have a couple questions from the audience here. So Derek, I'll shoot this one over to you. So someone in the audience has asked, are you seeing slower originations in 2023?
Yeah, so, we started off in this space fairly slowly. In 2017, we did one deal. That's mainly because we weren't very active in the space. And then it picked up over a couple of years. We were doing about 24 deals a year, so that's about 2 a month. 2023 has been quite a lot slower. And I think that's just originations across the board are down. That's not just in reverses. But in particular in reverses, as rates go high and we're in a high rate environment, the amount that is advanced on a reverse mortgage goes down. So if you had $1 million home and you could borrow $400,000 against that home in a low rate environment, accruing at, let's say, 4% or whatever, 5-6%. If you're paying 10% now, you can only borrow, let's say, 100,000 you can only take out. And that starts to look less attractive in terms of the amount of money you're taking out for the reverse. So it's as you're starting to get to double digits for rates, the reverses start to, originations naturally drop off a little bit. I will note that there's another product set which is kind of competing a little bit in the space, which is called home equity investments or home equity agreements, which we actually put out a request for comment methodology this Monday. So I invite anyone to go onto our website and try and find that. That's a comparator product that is operating in a similar kind of space, and that might actually start to pick up a lot of the borrowers that maybe find the high rates a little bit less attractive for reverses. They might start to operate in the HEI space, so that might pick up a lot of the slack there. And that's the answer. Joe, why don't I flip one back to you here from there's a couple pinging in the questions thing. Let me just read a few of these things.
Yeah, we only have time for probably a couple.
Okay, I'll tell you what we're going to do.
Some people had asked pretty similar questions, so see if we can cover a couple of these in one go here.
Yeah, I mean, have you read them? Maybe just fire one to me then. Yeah. Okay. So here's one. What are the potential events that could put a downgrade pressure away from housing? What are some performance metrics that should be focused on a bit more closely? That's an interesting thing. There's many different factors that kind of weigh into the analysis. If it's tailored to cities, right? So in the prop regime, if your payments come in too quickly, that can actually hurt the deals, like I mentioned earlier. So for example, if you have 100 million of collateral and you've got 110 of notes outstanding, and you get paid 100 tomorrow, you're short, right? So too fast hurts you, but too slow hurts you too as well, right? So there's a number of things that are going on. What else, Joe? Do you have any comments on that? The downgrade pressure.
I think you covered that mostly. Yeah. There's another question too, which kind of overlaps with some of the others here I want to touch on. It's why are the prop loans so much more likely to be paid in full versus liquidation? And that's a good question. I think we can actually move back a couple slides and look at that briefly here. So when you're comparing across the subsectors, props typically, the bulk of exit mode for a prop is generally being paid in full. Very little is liquidated, and most of that just simply has to do with the fact that there are far less defaults amongst the proprietary collateral. And to even go further, that may be related to the fact that the underwriting guidelines are more stringent. For example, on HECMs, there really isn't a technical minimum, FICO score, for example. Yes, there are other limitations in regards to financial assessment and being able to cover your property charges. But on proprietary products, most of them actually have a minimum required FICO score. And so typically speaking, you're just going to have a cleaner financial, credit profile for borrowers. So you're going to have less defaults and ultimately less liquidations.
Yeah. There's also a reason with the prop loans, they enter the life, they're typically more recently underwritten. They have much lower loan to values. So if an event happens, they're typically much more in the money. The other products typically enter us, at a valuation where their loan is about the same as the original valuation. So they're much higher LTV, and so they're also much more seasoned. So I think it just makes sense that the HECM product has higher loss severities and things as well. There's one question here in terms of can we share the deck and other primers, etc. And I'm sure our business development team will be happy to send this deck out after the presentation's concluded. I think we've taken about an hour, which is probably enough for most people, so maybe we should wrap it up. So let me just say thanks to everyone for hanging in there and listening. I apologize for a few technical difficulties, but I think it was a very interesting topic, so I'm glad to share more time. If anyone wants to reach out offline and dig into some stuff, some more questions maybe you didn't address, please just reach out. We're happy to chat. Thanks, Joe.
Absolutely. Thanks, Derek. Thank you, everyone.
All righty.